Larry McDonald, founder of the Bear Traps Report, which is one of the most robust institutional independent research platforms out there, and also the best-selling author of the book, A Colossal Failure of Common Sense, the inside story of the collapse of Lehman Brothers, which I should also note was named one of the top 20 business books by the CFA Institute. It is such an honor to have you on the show. And Larry, it is great to see you again. Welcome.
Thank you, Julia. It's been a long time. I miss our conversation, so looking forward to getting into it.
Likewise. And I was listening to the audiobook version of your book, and congratulations, by the way, being named one of the top 20 by the CFA Institute. And usually with this show, I like to kind of start with the macro picture, but I'm just dying to ask you something, because when I was reading the book, there was something in there that I'm like, okay, I just need to hear the story here. You hustled to get that first job on Wall Street, and I want you to tell it for the folks, if you don't mind. The pizza box story, incredible. Can you just like share where you got the idea? What was it? Because you weren't really getting any responses, so you started going around doing pizza deliveries of sorts.
Yeah, it's when you're younger, sometimes luck shuts the door and you got to come in through the window, as Doyle Bronson used to say, and the famous poker player. But your life in coming up through any career is about, there's a wall of inertia all over the world. There's all these invisible walls, and you as a younger person, you kind of come up against these walls over and over again, and it's just about having that burning desire to break through them and to get through them no matter what you have to do, and sometimes in more creative ways or more fun. But when I was coming out of college, the S&L crisis was pretty nasty, and it wasn't as bad as Lehman, but in some parts of the country it might have been, because it was more spread out, and it was pretty bad in New England, where I was from, because Bank of New England went under, and so I tried to get a job. I sent down my my resume to all these different banks, and I got rejected at least 75 times, and so I wanted to get into finance one way or another, either the institutional side or retail. And at that point in time, it was a lot easier to get into the retail side of the business. So I dressed up as a pizza delivery guy, and I wanted to get in, try to sneak my way into the Merrill Lynch office in Philadelphia and talk to some of the senior people. And I wanted to learn from them. I wanted to develop mentors. I mean, I was just, nothing was going to stop me. And I got up there, and I got in the bathroom. I took off my little overcoat and had the suit underneath, and these kind of senior guys came up behind me, and they were like, "What are you doing?" And I told them how I got in, and they were blown away. They were just blown away in terms of like humor, right? They thought it was so they brought me on the trading floor, and we went back and forth about what it takes to get into the business, and they they taught me a lot of things. It was kind of like, and those were some friendships that from that day really helped me over those years that followed.
Yeah, I think that was probably like the most ingenious idea I've ever heard for like how to get it. I mean, yeah, because you were faced with a lot of rejections, and just finding like a creative way to get in there. And hey, I would have taken the pizza.
Yeah, and back then, the buildings in New York and Philadelphia today have these advanced security systems, so you can't possibly get in without like signing at the front desk and then having a code they have to press to get into the elevator. Back then, if you just kind of, with a little creativity, you could really get in and meet just about anybody you wanted to meet.
Yeah, I love it. Just to recap though, like, so you did get to Merrill Lynch. Can you recap a bit about your background for folks who might not be as familiar with you? Just kind of share a bit about your career, where you've been, and how you got to where you are today.
Well, I started off on the retail side of the business in the 90s, and it was a period of massive disruption. The internet was just born, and it kind of really shocked me, because I started to build a decent business, but then in the mid 90s, it was very clear that the internet was coming, and then what might that do to a retail business? Like, so in other words, if you have clients, you're thinking about online brokerage, you're thinking about clients with technology may not need the retail advisor as much. So I kind of hedged myself in. After about 4 years, I had a friend of mine in New York and Philadelphia, and we started a website called convertbond.com, which was the first website in the world that brought institutional investors and retail investors the entire U.S. convertible securities universe. And we actually made a decent amount of money. We would have been better off creating a dating website, right? Or something like that. But we sold it to Morgan Stanley in October of '99, and that was kind of giving my big break. That got me from retail into the institutional side of the business, into trading, and that was kind of my big break. But October of '99 was a good time to sell, and we were very, very lucky.
Yeah, definitely a good time to sell. I want to talk about today. And we can get into like your work too, but just let's kind of frame it up. Let's do the big picture, the macro view. What are the things that you are thinking about the most today?
Well, so because of where I started, my goal every week, every month, every day, every morning is to democratize information. And I try to do that on Twitter, but I'm really proud of the fact that we built this institutional business. And when I was coming up in the business, a lot of times when I was at Lehman, I saw like we would have this incredible research on the institutional side that are what we call proprietary research that wasn't really published. That would go out to the institutions first and really kind of get picked over from the credit clients, which we call clients that more interested in fixed income part of the capital structure, so bonds versus equities. And then they would have kind of repackaged it and get the research out like a month later, 2 months later to the retail audience and the high net worth investors. And so what we do every day here at the Bear Trap Support is we run a live conversation with about 650 institutional investors in 20 plus countries. And these are hedge funds, mutual funds, pension funds that are looking at asset prices during the day. Like today, for example, break-evens are really your ultimate inflation expectation indicator. And what's fascinating through this whole inflation cycle is inflation expectations on the long end have really been anchored. Like, so Yale Blaine, the Fed, Miss Brainerd, and the different Fed governors that Miss Brainerd just left the Fed for the White House, but Governor Brainerd and all the Fed governors really have pounded the table that long-term inflation expectations have been well, and they said, I mean, how many times have you heard this? Well anchored, right? And that goes back to the 70s and 80s, where that was the first time that the only time in my lifetime where long-term inflation expectations became unanchored was during that period. And we're kind of in that period now where they've been able to anchor the inflation expectations, but then they soften the path a touch. Some people think maybe a little early, and now gas is up 17%. Gasoline is up 17% from the lows. Oils, a lot of things are kind of things like wages, like companies like Home Depot are spending $1 billion on extra wage compensation. And so the problem is, if you don't, and you really need 8, 9, 10% unemployment to kill inflation. And so if you don't kill it, it just it kind of gets into the seat cushions and it sticks around. And then all of a sudden, one day, long-term inflation expectations become unanchored. And we're getting, that's one of the conversations today, is that this is starting. It hasn't happened yet, but for the first time, we're starting to see like, wow, 1 year inflation expectations have moved up over 140 basis points since January. 5 years have moved up a lot. The 10 years haven't moved up as much, but something's going on where the stickiness of inflation is like putting its roots into the market beneath the surface, and it's going to be with us for a while.
Yeah. I want to hear a bit more on that, like the stickiness of it. Let's flesh it out a bit more. Do you have a number in mind? What are you thinking about as it relates to inflation and being more pervasive, sticky?
Well, one of the things, so our next book is about this concept where and it'll be out in the fourth quarter, in worst case in the first quarter next year. But this is kind of a preview. So because for the last 15, 20 years, inflation expectations have been well anchored, there's trillions and trillions and trillions of dollars in what we call financial assets, so bonds, growth stocks. There's just a ton of wealth that's in a world that's designed for inflation normalization down to 2% or less, right? So because every recession we've had since the 80s, inflation has been able to normalize pretty much, since maybe the 90s. Lehman, COVID, there's been a normalization well below 2%, in some cases 1%. And in that world, financial assets, growth stocks, long duration plays do wonderful. And so if inflation expectations are starting to become unanchored and we normalize at 4% instead of 2%, and we hang around there for a while, Julia, if that's the case, there's trillions and trillions and trillions of dollars that are misallocated, and we're starting to see a rotation. Like we already know that a year ago today, the NASDAQ 100 had $20 trillion in it, right? 20 trillion, and that's come down to about 15 or 16, probably more like 50. So the 5 trillion has already left the NASDAQ 100, and it's gone into some other things, global growth equities. European equities are making kind of all-time highs because those stocks are more value-based, right? So I think we're at the genesis, or maybe the second, third inning of this transition to a world where inflation normalizes at a much higher level, and therefore there's a reallocation of assets globally.
Okay, this is fascinating. That's why I love this show, because I get to listen to folks like yourself and help others understand this. You're saying trillions of dollars right now are misallocated. Help me understand what are markets missing, or what are investors missing? I would love to kind of tease this out a little bit, because maybe like the everyday person might not understand this concept of, it's starting to be unanchored.
Well, there are models that models equity valuations. And if disinflation is very certain, then growth stocks, or the net present value, all future cash flows, right? In a world with deflation or disinflation, the net present value of all future cash flows. Think of like Netflix or any company that produces cash and retains that cash. If you have a disinflationary world and you're producing lots of cash over 10 years and you're retaining that cash is worth more, right? But if you have the same type of company, and your net present value of all future cash flows in an inflationary world, and you're retaining that cash. But if it's in a world with inflation, that's more certain, right? If you have very certain inflation that's anywhere between 4 to 5%, so the modeling of those types of companies collapses. So you can have a company like that, Microsoft, that might trade at 30, 35 times earnings, or Nvidia 50 times EBITDA. In a disinflationary world, that's okay. And believe it or not, you can actually make money, because you can buy a company at 40 times EBITDA and sell it at 50 times EBITDA, because in a disinflationary world, those future cash flows are worth more, and then there becomes like this gain. And the Fed doesn't remember, in a disinflationary world, the Fed's on the sidelines, right? In a disinflationary world, the Fed's not kind of lurking like, we're going to be potentially coming back here with more hikes. In a disinflationary world, the Fed can easily just be done. But in an inflationary world, the Fed has to hang out. Let me give you an example. Today, the 6-month Treasury. So say you have $1 million. You're sitting in investor sitting at home, a wealthy investor with $1 million. Today, that investor can get $51,000 in 6 months from the U.S. Treasury in interest. $51,000 on $1 million. $1 million. Put it in a T-bill for 6 months, and you're going to have $51,000 of interest in 6 months, guaranteed by Uncle Sam. A year ago today, that same investor was looking at 6,000 of interest, $6,000, right? So what's happening is as inflation has become more certain, the Fed's pushed up the front end, or yields, those front end short-term yields, and that's pulling a lot of money away from stocks for the first time in most people's lifetimes. Like most investors are probably 30, 35, 40 or less, right? So that cash component is now, and inflation is now presenting a threat to growth stocks that wasn't there before. And now people have to reallocate into other types of concepts that are going to benefit from, or that will do better in that kind of sustained inflationary world.
Okay, there are a lot of, again, this is great, more interesting things. But you just said, okay, if you had a million in like in 6 months in 6 month T-bills, you could get, you said 51,000 in interest off of them. Can you repeat what you said? I just want to hear it one more time.
So let's just say you married couple with $1 million. You can put in a 6 month T-bill today and get $51,000 of interest on $1 million. So that's 5.1% for 6 months. And so that's the case today. But for the last 10 years, especially the last 2 years, that same retired couple with $1 million was getting about 6,000 a year, especially like 2021, beginning of 22. And so that retired couple was forced into all kinds of crazy investments. But now the S&P is basically unchanged for 2 years. And so there's a wall of supply above us, right? So as the market rallies, there's a lot of people that are kind of like flat for 2 years. And as the market rallies, they can get their money, they can get even, right? And so you had $1 million in stocks 2 years ago. Now that you were down 400,000, now market's rallied and you can get that money back potentially. And what are you going to do? Okay, you got your money back. You can keep it in stocks, or you can put $1 million in a T-bill and get 51 grand in 6 months, which is like car, right?
Yeah.
That's a little bit, that's a threat to stocks that we haven't seen, that most of our viewers have never seen before. Like, so you got to be, it's not that you should be bearish, it's just to think about, okay, the average investor today can take 51,000, can take $1 million and put into bonds, short-term risk-free bonds, and get $51,000 per million of interest. Whereas a year ago, that same person was dealing with 6,000 a year of interest, or maybe 6 to 10, whatever it was, but it was much lower.
Interesting. Okay, so to kind of delve into this notion too, like that trillions are currently misallocated. Where should folks, or I guess I don't know if you want to go there, but what are some of like the areas for allocation? What is interesting? Where are the opportunities right now?
Well, if you look at the planet Earth, right, in a disinflationary world that's been very certain deflation, there's been a lot of money that's moved into the United States because we're the growth stock king of planet Earth. So you have the situation in a certain deflation for like the last 10, 15, 20 years. What happens is all the money, a lot of the wealth in the world went into the United States of America, which is a good thing for the stock market. And because there's a lot of growth stocks here. But if you look around the world, in the United Kingdom and Europe, there's a lot of like very large value stocks, BP, and say, look at the EWU portfolio. That portfolio has Shell, it's got all these like global value plays, Glencore. And so these global value portfolios, or just global stocks in general, like global stocks that are outside of the United States and other developed markets, the last like 5-10 years, the US market was trading at like 18 to 25 times earnings. And the other developed markets of the world were trading at 10 to 15 times earnings. And so there's some global value stock portfolios, like just to keep it simple, like the EWU, which is a beautiful basket of value companies that are hard asset driven, like a lot of commodity type companies. And those stocks are trading at very cheap valuations. And because of that, like I said, because of that more certain inflation, there's a move out of kind of the United States into, and that's why you got France and Germany and the UK are breaking out to all-time highs, whereas the NASDAQ and the S&P are flat for 2 years and running into massive supply. If I had a chart, I can show you, but you have like literally trillions of dollars of wealth that's dead money for 2 years in US stocks. And people, there's an old saying, people want to get even and get out.
Yeah. I want to go back to, you mentioned you're writing a new book, and I don't want you to have to give away everything, but what are you writing about? You kind of mentioned, I just want to hear a bit more. Like, what are some of the big themes to you that are really interesting right now?
Well, you know, we go back to Lehman, right? So the first book, I was a trader at Lehman. I brought people inside the bank, and we're kind of heading toward the iceberg, right? And it was one of those moments that you'll never forget. You're heading toward the iceberg. I was on the Titanic, Lehman Brothers, and you know, in that case, the Titanic never swerved at all. I went right into the iceberg. And so there was a sovereign bailout of the banks, like the governments of the world bailed out the banks. Then, you know, COVID hits more than a decade later. And the bailout for the Lehman financial crisis was about, in terms of total fiscal, total monetary bailout, where the sovereign governments bailed things out, was about $2.5 trillion, right? $2.5 trillion. And this is part of my book where we go into the COVID era, and it's a fiscal and monetary bailout of lockdowns, of experimental lockdowns, and we can debate whether or not they did, politicians did the right or wrong thing. The bottom line is they spent $10 trillion, and 40% of all dollars ever created, 40% of all dollars, US dollars ever created, were done so in 2020 and 21 under President Trump and President Biden. So it's a bipartisan thing. And so that's a sovereign bailout. And then now you have these energy situations around the world where, you know, there were very high gas and oil prices in Europe. There was massive recession risk. And what did the governments do? They essentially printed money and they paid people's electric bills around the world, California, and they didn't really allow the traditional. Normally what would happen is a business cycle, oil prices would go up, they create a recession, and that would create kind of deflation. This time around, it was the third sovereign bailout. So the sovereign governments bailed out Lehman, they bailed out COVID, and now they bailed out, so it's like almost an $800 billion bailout of energy prices. And so it's the three big sovereign bailouts have created a lot more government debt. So the next crisis, the Lehman crisis, was more bank balance sheets. The next crisis that's coming at us is more from a government point of view. So there's so much more government debt, and there's so much more central banks that have that debt, that are wearing those losses because interest rates have gone up. And so it's the book's about kind of, okay, it's a new world with a lot more government debt, and that means you're going to have a lot higher interest rates going forward. Like, we've permanently come into a new higher interest rate regime.
Yeah. Does that mean, like, at some point, do you think we get like a debt jubilee or something? Like, what are you kind of thinking? Like, how do you think, aside from like higher rates going forward, or being like the kind of norm going forward, how do you think this kind of plays out?
The debt jubilee thing is there's no question it will come into some large developed market country, whether it be in the United Kingdom, and we already had a little bit of a preview of that in October in the United Kingdom, where the long end of the curve exploded higher, and even the front end too, and there was massive, like they put forth a plan for this new government, and it wasn't really thought through relative to how the bond market would react. And the central bank was promising to do quantitative tightening. In other words, the central banks can suppress, Bank of Japan has proven the central banks can suppress interest rates for a long time, but inflation was running 8, 9, 10, 12% in the United Kingdom. So the central bank wasn't allowed to really step in and really hold bond yields down. So we had a period where within like 20 days or 15 days, interest rates in the United Kingdom were just in a spectacular parabolic move higher. I mean, just like, and that's very, very destructive to a lot of different businesses. So that situation's coming, but governments and central banks can do a lot of things to push it out. And but at the end of the day, you know, we have in the US government, we have the interest as a percentage of the budget. Like say within the last year, it was 8%. So if you take the United States budget and you take the interest on the debt, it was 8%. And if the Fed, you know, the Fed's pounding their chest that they're going to fight inflation, they're going to kill inflation, they're going to try to keep rates up here at 5 to 6% and kill inflation, right? The problem is if you do that, and this is interesting because on March 7th, Powell's going to be on the House and the Senate floor, and he's going to give, for the first time, he's going to get a lot of hard questions about this, because if you keep the Fed funds rate up here for 12 months, Julia, a year from today, your interest as a percentage of this budget spending, it's going to be like 15%. So from like 8 to 15. You know what that does? That wipes out a lot of like fiscal discretionary spending. You're talking about capital that's supposed to go into scientific research projects, medical projects, all kinds of things, right? Now, granted, a good, huge punch parts of the budget are non-discretionary, which are just automatic, you know, like Social Security and cost of living adjustments, and so a lot of the budget is non-discretionary, but that discretionary component is pretty large. I think it's like 20, around, I think 22%. That's at risk. And so that could create a real problem within the next 12 months if the Fed were to keep rates up here.
And what do you think? Do you think they'll keep them up there? What are your like? Do you have outlook on where they'll keep rates?
Yeah, the problem is you don't kill and like Wall Street's been selling us on like the last 4 weeks that a soft landing or a no landing is a good thing, and because it protects earnings and the like. But it's really a bad thing, because in a soft landing or a no landing, without 9 to 10% unemployment, you don't really kill inflation. And so what happens is inflation comes down and then it either bounces or stays very high. And so if the Fed doesn't take rates really high and crash the economy, they're just not going to kill inflation. And so right now they're trying to be cute with it. I understand, we all understand why they don't want to create a Lehman Brothers, right? But the more cute they get, interest rates are so high that investors right now, like I said, have an extra 50 billion of interest a year. That's just from the high net worth individuals have an extra 50 billion. They're spending that money. That's why LVMH is at all-time highs, Louis Vuitton, Tiffany, and you've got all these like stocks like Ferrari is up. You look at Ferrari's up 14% year over year, and Big Lots and Target are down like, and Macy's are down like 20 to 50%. So the bottom 50% of people is really hurting, and the top is doing very well. Now, that gets you back to what the Fed can do. If the Fed doesn't kill inflation, they keep inflation up here, and that creates more pain for the bottom 50%. And so they're probably going to try to push it as hard as they can, because the election's still 2 years away, right? If so, they can really push it here and push us into a recession and try to really kill inflation that way. That's what they're trying to do. But they pause a little bit 2 months ago, like in October, and that created this revival in inflation.
Yeah. You mentioned something interesting, like Ferrari doing well, LVMH, these ultra luxury type brands, and then you're more like everyday retailers not doing so great. And that kind of, as you were pointing out, gets at like the divisions, I guess more like economic so like divisions here. Do you think much about like that? Like what, because if you go back to even like the financial crisis, um they were in like the aftermath of that, and it kind of feels like, I'm just like extrapolating here and I want you to explain it. And is it like we're sailing toward another maybe bigger iceberg here? And what about the kind of like undercurrents, more of like the social fabric here when you're mentioning kind of like the divide, if you will?
You've got a great sniffer, because where you're going with this is, I can tell you're such a seasoned veteran. You can see what you're connecting, like Occupy Wall Street, right?
Yeah.
So they bailed out the banks, and then there was this massive social revolution, what was called Occupy Wall Street. It had an incredible grassroots organization, and it was very it was pretty crazy. I mean, you had a lot of people there was inequality was very high because of the crisis, and the bankers were getting these bailouts because they needed to save the system. So they bailed out all the banks. And so they took federal dollars and they bailed out all these banks. It was trillions, over $1 trillion. It was like 2.5 trillion of fiscal and monetary. But think of what's happening now. So think of what's happening now. It's very similar, same thing is happening. Instead of the financial crisis to try to fight that off, now they're trying to kill inflation. So they push the Fed funds rate up from 1% to 2% to 3% to 4% to 5%. What that does is, if you're, like I said, if you're a wealthy American, you're sitting with millions of dollars in the bank. Every $1 million you have is now paying $51,000 a year, right? Like we just talked about before. That group's doing great. And that group is benefiting from the Fed and from government policy. Now think about the bottom 50%. There's $4.8 trillion in financing, auto financing, home loans, credit cards, 4.8 trillion. And the problem is, when you pump up the front end of the curve, credit card interest is, I think, at all-time highs right now. And during Lehman, it was like 14, 15%, right? In that period afterwards. Now you're up there 20, 21, 22. So the average person, the inequality that's developing, because in the case of the Lehman crisis, there was this inequality that developed because of the crisis, and Occupy Wall Street exploded. And now what you're getting at is, it's really like Robin Hood reversed, where the little guy is getting hit by inflation. They're getting hit by this higher on that $4.9 trillion. Every 1% up, it gives you, I think, it's $40 trillion of extra interest costs for the little guy and gal. So every 1% that they took interest rates up, it costs the little guy and gal, or the middle class family, all that whole group, an extra 40 billion. Okay, because they're raising that interest costs on credit cards, on home, home equity lines of credit, everything. Whereas the larger, the top 30% is sitting on so much cash. I think it's like 1.3 trillion of excess savings that's in the hands of not the little guy and gal. It's really in the hands of the top 30%. And God bless those people. They've saved their money. They've made a lot of money in the private sector. They've done well, but it's just like, you got one group that's getting this huge windfall of excess interest, and you have the bottom 50% that's getting this just punched to the stomach of inflation and higher interest, which is creating this, like you said, like what you were alluding to, is like this kind of like Occupy Wall Street, like 2.0 in some other way, like some other social revolution is going to form.
Yeah. And then I even wonder, like with this goal of wanting to like even boost unemployment in order to bring down inflation, who's going to get hurt in that scenario, or who are the folks who are most vulnerable in that scenario as well? It's just something to think about.
Yeah, I mean, this is why you really want to watch the Senate testimony on the 7th, because these are the types of questions that are going to get more and more. It's going to be a lot more of a attention show on Capitol Hill, from Elizabeth Warren up against Chair Powell.
Yeah. If you had to ask Fed Chair Powell a question, if you were one of the folks on Capitol Hill, and maybe sorry to put you on the spot, what would be your question for him?
Well, I would get into what we were talking about before. I'd say, Mr. Powell, we know that it takes very high interest rates to kill inflation. We know, looking back at the last 70 years, that inflation has never been killed without the Fed funds rate being at or near or above the rate of inflation. So right now, inflation is still 6.5. Fed funds rate is a little bit less than 5. So we're not in anywhere near the historic kill zone. And therefore, if interest as a percentage of the budget is right now 8%, and you push interest rates up to 6.5% to try to kill inflation, and you take that interest as a percentage of the federal budget and you drive it to like 18%, that's an enormous burden on not just unemployment that we cause and that type of crisis to kill inflation, but it's also you're wiping out a lot of federal spending on the discretionary side. And I would like to see him just answer the question as to acknowledge that they really can't. My question would be is it, when you say that you can keep Fed funds rate here for a year at this level, isn't that kind of a lie? Because if you do, the political pressure against the Fed is going to really be pretty strong a year from now.
Yeah. I want to go back to, and you mentioned it, you're right, there has been a narrative floated around lately of a no landing scenario. We've obviously heard the soft landing scenario, and obviously also the hard landing. Where do you kind of stand amongst those scenarios? Do you have thoughts on what kind of landing, if we will see one, what that could look like, one that you're leaning more toward?
Well, they have to do some more now because inflation has bounced. And so they're definitely going to create a hard landing. But we had a nice little period there where there was some hope that they wouldn't have to create a hard landing. And remember, the Fed governors, when they talk to us through the media, they're like the pilot on the airplane, right? They're not going to say that we have engine trouble. They're going to say that we think that we can kill inflation with the Fed funds rate right here, and they think that we're going to avoid recession and kill inflation, which is just preposterous. And so I think it's going to be a hard landing, but with nothing. I mean, we kind of historically we need hard landings to kind of vet out. It's not good for the little person, but you have a lot of people that were making bad, just like this whole crypto thing with SBF. There's all these businesses and all these, because they had disinflation for so long, there are all these toxic, God knows how many of these situations that are out there where bad actors have really ripped off investors. And without the tide going out, you don't cleanse that. You probably have 10 Madoffs out there. And so you need to let the tide go. I mean, the last 100 years, the way capitalism worked, the tide goes out and you cleanse the bad actors, and there's a nice rebuild out of that. So it's going to probably be a hard landing, but that doesn't mean we can't invest and kind of work our way through it. And but unfortunately, it's just the only way to kill inflation is with that hard landing.
Yeah, well, when the tide goes out, we find out who's been swimming naked,
Yes.
the old adage goes. It also makes me just wonder too, and maybe you have thoughts here. Was there something that could have or should have been done? And gosh, let's call it the last decade plus. We obviously had a decade of zero interest rates, but was there a time I don't know, if you have any thoughts on the last decade plus of policies, or maybe we could have avoided this kind of impending iceberg that's out there, if you will, or where the
Well, it's
mistakes were
just
made?
like it's like everything else. They've been trying for 20 years, and they don't want, when you don't allow the business cycle to function over longer and longer and longer periods of time, you create more and more excesses, and so you create more and more bad behavior. You're not allowing, we called it moral hazard. When Lehman failed, right? There was a lot of people that wanted the government to bail it out. And one of the things I talk about in my book is there was a group of people in Washington that wanted to let Lehman fail because they thought it was like this moral hazard moment, whereas if they bailed it out, they'd already bailed out Countrywide, they essentially bailed out Bear Stearns. And so there was this like growing feeling in the market that they weren't allowing the business cycle to function. And so they let Lehman fail, but then they took 2.5 trillion of fiscal and monetary, and they did, zero interest rates for all those years. COVID hits, zero interest rates again. And they probably should have let when you suppress the cost of capital for longer and longer and longer periods of time by suppressing interest rates, you create all kinds of bad distortions. And now, because of inflation, they're forced to let the market discover the true cost of capital, right? And now when that happens, it blows up things. And we haven't seen the big blow ups yet, but we have had some parts of the market like commercial real estate. There's no question a blow up is happening there, but it's slower because of the way the market's structured and the financing. And the leveraged loans is $1.5 trillion of wealth in there. Those are adjustable rates, so there's a little bit blow up happening there. And so on the consumer side, you've got auto loans it's a lot of weakness there, and some subprime mortgages and subprime autos. So you've got all these little spots of weakness, and that's where it's kind of like a slow moving crisis that's coming at us.
Yeah, yes, slow moving as you put it. Since you also focused a lot on macro, maybe we can kind of tick through some of the different areas. Let's start. I want to hear your thoughts on energy. What are you thinking about within that space? Is there anything? I guess you have a lot of these conversations with institutional investors. What's kind of top of mind for you as it relates to energy?
Well, the natural gas names versus the oil names are trading at like one of the cheapest levels of all time versus the oil names. So everybody's like hiding out in energy oil stocks. But the natural gas names, because we've had this big move down, we've had the warmest winter in 20 years globally. And you had this big restocking into that. And then you had the Freeport disaster, which is like this facility where we were going to export a lot of LNG, natural gas. And that facility went down, and it created this like huge buildup of natural gas in the United States, even though the planet needed our natural gas. But because of this problem, so you've had this wacky confluence of events that have created like Southwestern Energy, SWN, or Antero, AR. You've got these stocks that are trading at like very cheap valuations that offer, I think, tremendous upside for investors over the next 10 years, because you've got this new super highway of demand between the United States and Europe that is out there. It's coming every year. Germany just built another 3 LNG terminals, but we kind of have to build the highway, and that's being built. Cheniere just made a massive investment late last week. And so between Cheniere and the German government and many other governments in Europe, this 6-7 lane highway between the United States and Europe is going to create this massive reservoir of demand for natural gas. So natural gas prices, although they've come down here near $2, they probably spend much of the next decade between 4 and 7, 8, which is on the high end. And so that's one area where I think, right now a lot of people are hiding out in Exxon and Chevron, and there's nothing wrong with buying the dips and some of these things, but I think there's a lot more value in the natural gas space. And then emerging markets, the emerging market local currency bond fund from JP Morgan is paying like 6%. It's local currency. So if we go into a world where Europe's doing a little bit better over the next year coming out of the war, there's no question that it's going to be some type of, no question there's going to be some type of resolution there in the next 12 months. It's just massively unsustainable on all sides and financially. And then China's reopening. And so, and the US is weakening relatively. It's kind of last in or first in, first out. So Europe and global economy was in a weaker spot last year. US goes in last. So you get a weaker dollar over the next year, not a dollar crash, but that's an environment where your emerging market local currency bond fund is trading below COVID levels. So when we had this global synchronized growth sales pitch from Wall Street banks in 2018, and where the US dollar was weaker and the global currencies were stronger, this type of fund traded near $37, right? And now it's trading, at COVID it traded at 26, and now you're near 24. So baskets of bonds that are from, believe it or not, like emerging markets in some ways have better balance sheets than developed markets. It's crazy. I mean, it's just absolutely crazy to say that, but it's the truth. Mexico bonds have been Mexican equities. So I think there's going to be a real renaissance for, and it won't last forever because you can't really you can't buy and hold some of these things for long periods of time because there's just too much disruption in emerging markets. But I just think you could have a nice 3, 4, 5-year run where like the EEM, Brazil, EWZ, EMLC, you've got these local currency bond funds, equity funds, countries that are long hard assets like Brazil are just this natural. The probability of them doing well is very high.
So like a renaissance in emerging market bond funds?
Bond funds and equity funds. I like that EMLC because it's local currency. And so what's happened is the dollar ripped last year. So a lot of the bonds in that fund were trading at par. Now they're trading in the 80s. And so you have a lot of upside because the bonds are lower in price and you've got a 6% coupon. But Brazil, for example, is a country that's max long a lot of different commodities, and you've got the United States has to reshore and also build a supply chain that goes north-south, right, in this hemisphere versus the whole east-west supply chain that has existed since the last 20 years. It's been built between the United States and China. That's all going to have to be reassembled to some extent north-south in this hemisphere. I sat down in Brazil, in Sao Paulo, with Andrea Steffes, who's a billionaire. He's a wonderful guy. I go to his office and he's like, "Larry, sign my book." He's like a big fan of mine. And I did some research on him before the meeting. He's like one of the most successful investors of this generation in that part of the world, worth 17 billion. But he's a big fan. I got a big kick out of that. And we talked, and he talked, that was his thesis around this north-south supply chain. And countries like Brazil are a pretty good place to take advantage of. And he's the CEO of BTG Pactual. And I said, "Andre, what does BTG stand for?" And he said, "Better than golden."
Well, I take it as a joke, though. Got it.
Funny guy, but brilliant.
Okay, so this is a way to play. Wait, I want to hear about the supply chains because you're just alluding to that, like the conversations you've had. What's the kind of the thought or the thesis there?
Well, you've got, we have a sickening situation where globalization is a good thing to some extent, but when it's in place for long periods of time, it really drives complacency. And so the U.S. took 500,000 jobs and we exported them around the world, right? The last 20 years. We've decimated the Rust Belt. We have cheap products that come in from all over the world, which is a good thing for consumers in the last 20 years. But the problem is that we've decimated the United States, and we've, as COVID showed, Bob Kraft and the New England Patriots had to to get one of their planes to go over to Asia to get masks for the city of Boston. I mean, that's how bad the situation was. Where so there's a lot of, like, whether it be uranium or masks, we can sit here and probably name 70 national security issues with rare earth metals, on and on and on. I mean, think of like wind, right? Wind farms need very rare earth metal for the magnets that are inside of these wind farms, right? Or inside of these windmills. And so there's just countless cases of national security, foolish, complacent, horrific risk that's facing the United States. And it's because of this whole East-West supply chain that was working as smooth as silk. And after the Vietnam War, this, we went from a Cold War to globalization, and we really just overdosed on it. And it's just, for the COVID world and the Ukraine-Russia thing, it's just proven to everybody that you need some type of insurance policy, some north-south supply chain in this hemisphere that backs up. So if your supply chain is too far exposed to China, Russia, or whatever the national security component is, whether it be uranium or whatever, we need to have a supply chain running from Canada, Panama, Mexico, Brazil that backs up or near shores the risks that we dealt with.
Mm-hmm. And also, like, couldn't that also, I'm just asking, like, as a follow-on, when you reconfigure the supply chains, couldn't that you also make an argument too, like, well, could also be the end of like cheap goods or inflation, again, going back to the inflation thesis, that it could be stickier because things will just be more expensive as well? Is that part of it?
It's like a massive regime change where at the end of the day, disinflation was an addiction to a global supply chain. That's one big component of it. There's a lot of other components like technology, and we can sit here and say all kinds of incredible things about technology, deflation, but there's a whole bunch of other components that have to do with the way the planet works, that when we change this and we nearshore, and President Biden, a smart thing, he literally took the Trump playbook. And Trump in 2016 came up with all these really kind of sales pitch ideas for reaching out to middle-class voters. And in the end, you can argue whether or not he was successful or not. Some people say he wasn't very successful. But the concept was, okay, China, globalization. Trump lectured the Germans. He said, you're too exposed to Russia on natural gas. Let's have a relationship where Germany imports more natural gas from the United States. So Trump had some good ideas, and the Biden team's done a great job of picking up on those ideas and running with them and repackaging them in a really clever way, and probably selling them in a more sensitive way. But you can make a case. So all of that is, like, you can clearly see the Democratic Party is embracing these very inflationary trends. So just think of like President Biden bragging about the cost of living adjustments inside of COLA and Social Security. And so you've got this massive increase in income that's heading towards Social Security recipients, which is a good thing, right? But it's an increase in pay because of inflation. And so you have that big component. You've got nearshoring. You've got this, like I said, global supply chains that just don't work as well. And so you've got all these new factors that are making inflation far more sustainable.
Yeah. I didn't ask you this. I kind of probably have a general idea of, like, where you are. Are you okay? I take it you're usually pretty bearish. Where do you stand today, and how would you contextualize it? I guess, like, within your career, like, what's kind of your current sentiment, if you will? Maybe you're bullish, maybe you're bearish. Like, where?
Yes. So I was a CNBC contributor for 7 or 8 years, and I was thrown. The problem with the messaging there is I'm really a value investor. I mean, I love David Einhorn, Greenlight Capital, Buffett. I really respect those types of investors. And what happens is, when the Fed, in a disinflationary world, and the Fed can be extremely accommodative, it creates a landscape where all these wacky types of businesses for long periods of time can get crazy valuations because the Fed's always there. It's always there buying bonds, always there doing QE. But in an inflationary world that's sustainable, the Fed just can't be there in the same way. So everything acts differently. So we could go into a period where from 1981 to 1968 to 80, 1968 to 80, the S&P was flat. Okay, that was an inflationary regime. 68 to 80, roughly flat. And doesn't mean you're bearish, but there's going to be parts of the market that do really well, and other parts that, like last decade's portfolio, probably doesn't do as well because you're not in that disinflationary regime. So everything that worked the last 15 years in a certain disinflationary regime is not going to work in this time around. And you have all these younger investors that want to go back to the same playbook. You can see them this year. I mean, they're going back. We had a beautiful counter-trend rally in the NASDAQ, but there's a lot of supply up there, and the risk-free rate is 5%. And the last couple of times the NASDAQ went to all-time highs over the last 10 years. You had some overhead supply, but the risk-free rate was 0 to 1%. And the Fed was doing QE, and that's what got you through that supply. So now if you have overhead supply, what I mean by that is, you've got the NASDAQ is dead money for 2 years. The S&P is dead money for 2 years. And you have $1 million in the market. You were down 40%. So you had your $1 million went down to 600,000. Now that $1 million is back to $1 million. What are you going to do with a risk-free rate that's 5%? And you got your money back. Most likely, you're going to get even and get out and put it into cash. And that's just a common sense thing. If the Fed was doing QE, if the Fed was suppressing interest rates down to 1%, that whole last decade's playbook works really, really well. But we're just not there.
Yeah, the world's changed. Well, Larry, I've really enjoyed having you on, and I feel like I learned a lot. I can't wait to get your new book when it comes out, and I'll have to have you on again. But I want to give you a few minutes. If you want to share more about the Bear Traps report or any of your work there, if you want to let folks know where they can pick up your first book, or follow you on social media. And also, if you have any parting thoughts, anything that's kind of top of mind for you that we didn't bring up in this conversation, please take the next couple of minutes to do so.
Well, the one last thing is around rare earths and the green revolution. So that's another area that is extremely potentially bullish over the next decade, because there's a group of companies out there in the uranium space, in all kinds of areas that benefit from wind and solar, Hecla mining in the silver space. You need a massive renaissance in silver demand, copper demand, all these different uranium for nuclear power. So I'm extremely bullish in that area. And we've done a lot of work, and we work with a lot of investors in our live chat. But the genesis of what we do is we run the live conversation on Bloomberg with the institutions. 80% of our revenue comes from the institutional investors. What we try to do is, like I said, my goal, because I started off on the retail side, is democratizing information. And we do that through books like A Colossal Failure of Common Sense, like our next book, and we do that through Twitter. We're sure Act and Convert Bond on Twitter. But we also do it through the Bear Trap support, where we recap that. We give people a lens on that private club conversation. What are the institutions thinking now versus last week, the week before? And we kind of help the small investor or the high net worth investor or the family office or the financial advisor. One thing I'm shocked at, we have 1,000 financial advisors that pay us on our gold level subscription around the country, from Merrill Lynch and from Raymond. These guys, they're wonderful guys and gals, but they don't trust their own in-house research. And they subscribe to people like Hedge Eye and Bear Traps and Jared Dillian. There's a lot of great, Keith McCullough. There's a lot of great resources out there of people that provide an alternative to Wall Street research, which is kind of an old business model, which I think is breaking down. And that's kind of my mission, is to democratize that information and kind of even the playing field.
I love that. Well, Larry McDonald, best-selling author of A Colossal Failure of Common Sense and founder of the Bear Traps Report, and also at Convert Bond on Twitter. It has been such a delight having you on the show. I can't wait to have you back on. Thank you so much for being so generous with your time and ideas. I really appreciate it.
Thanks, Julia. That's great. I had a lot of fun.
Thanks, Liz. Hey, everyone. I really hope you enjoyed that video. Be sure to hit that like button, the subscribe, and that bell so you won't miss any new videos.